Rakesh Jhunjhunwala, often referred to as the big bull of the Indian stock market, followed an investment strategy rooted in a mix of value investing, contrarian insights, and a focus on India's economic growth story. His approach had unique twists, some inspired by Warren Buffett and other value investors, but adapted to the dynamics of the Indian market. Here's a breakdown of his key investment principles. 1. Identify growth potential in undervalued stocks. Jhunjhunwala looked for stocks that were undervalued but had significant growth potential, particularly those in sectors aligned with India's growth story. He believed in buying into promising companies before the broader market recognized their value. Example: one of his most famous investments was Titan Company, which he bought early when it was undervalued. Over the years, Titan became a leading jewelry and watch retailer, aligning with the growing consumer culture in India, and Jhunjhunwala's investment multiplied many times. 2. Contrarian approach. Jhunjhunwala was known to go against market sentiment. He believed that in times of pessimism, opportunities could be found, and he wasn't afraid to make bold moves in sectors others avoided if he saw value. Example: he invested in CRISIL, a ratings agency, when it was still a relatively small player in financial services. As demand for credit rating services grew, especially after India's economic liberalization, CRISIL became a prominent player, and Jhunjhunwala's investment paid off significantly. 3. Strong faith in India's economic story. Jhunjhunwala was bullish on the long-term potential of the Indian economy. He often invested in sectors that he believed would benefit from India's growth trajectory, like financial services, consumer goods, infrastructure, and healthcare. Example: he invested in Lupin, a pharmaceutical company, anticipating the expansion of India's healthcare needs and growth in the pharma industry. As India became a major player in global pharmaceuticals, his investments grew significantly. 4. Patient long-term holding. Like Warren Buffett, Jhunjhunwala believed in holding quality stocks for the long term to benefit from compounding returns. He wasn't swayed by short-term market movements and had the conviction to hold his positions for years, sometimes decades. Example: he held his investment in Titan Company for over 20 years, demonstrating his commitment to long-term growth. 5. Invest in quality management. Jhunjhunwala emphasized the importance of strong, credible management teams. He believed that good management could navigate a company through tough times, grow the business, and ultimately create value for shareholders. Example: his investment in Star Health and Allied Insurance showed his trust in management's vision for growth in India's insurance sector. 6. Diversified portfolio, yet concentrated bets. While he had a diversified portfolio, Jhunjhunwala concentrated a significant portion of his wealth in a few high-conviction stocks. This allowed him to enjoy the upside of his best ideas while maintaining exposure to various sectors. Example: apart from Titan, he held large positions in Lupin, Tata Motors, and CRISIL, showing that he wasn't afraid to place large bets on a handful of companies. 7. Adaptability and learning from mistakes. Jhunjhunwala acknowledged that he made mistakes but was always willing to learn. He admitted to losing money,